This week on Money Unleashed, we will be discussing stock splits. A stock split happens when a company increases the number of its shares. The number of shares outstanding increases by a specific multiple. The total dollar value of all of the shares outstanding will remain the same because a split doesn't fundamentally change the company's value. The most common split ratios are 2-for-1 or 3-for-1, which means that the stockholder will have either 2 or 3 more shares respectively for each share that they previously had held. Now, companies often choose their splits to help lower the stock's trading price and to make the stocks in more of a comfortable range for investors. Now, most investors are more comfortable purchasing, say 100 shares of a stock that's valued at $10 as opposed to buying one share that's valued at $1,000. So when the share price has risen substantially, many public companies will then end up declaring a stock split to help reduce the price. Now, for example, in August of 2020, Apple split its shares 4-for-1. Right before the split, each share was trading around $540. Well, then after the split, the price per share at the market open had dropped to approximately $135. Now, an investor that owned 1,000 shares of the stock pre-split would have then owned 4,000 shares post-split. Apple's outstanding shares then increased from 3.4 billion to approximately 13.6 billion, while its market capitalization remained largely unchanged at $2 trillion. Now, stock splits are generally done when the stock price of a company has risen so high that it might come off as a speed bump to new investors. Therefore, a split is often the result of growth or even the prospective growth of that company. It's typically a positive signal. Thanks for joining us here at Money Unleashed as we go through educational topics and all of the great things going on here at Hoffman Financial Group.